Vimal, I'm a little nervous because you told me you're the most bearish that you've been in some time, and when I was doing research for our chat today, I could find a big long list of bearish articles, but I thought we might try and keep today pretty, well, try and find some positives out there today for the start of the year. But before we do, this is genuine new information for me. Love to hear about how you got started as an investor. Because I imagine most people don't wake up one day and say, I want to become a bond fund manager and fixed income and defensive strategy. So what was your initial experience and pathway to becoming a fund manager?
Well, when I studied school, I did macroeconomics and microeconomics, and I found the microeconomics and looking for a corporate balance sheet is incredibly boring, but the macroeconomics had this kind of big allure around it. And then when you're going through university, I studied economics, maths and computer science, and I was always reading The Economist, and that was the time Liar's Poker was out, and so there was this whole exciting arena around the macro markets, and so I wanted to get into that, and so I applied for jobs and was lucky enough to get a job as a trainee fund manager. And when I joined, the plan was I was going to go on rotation through all the different departments. So I started off in the fixed income and currency team, was there for 3 months, and then they were going to move me into equities, and I put up my hand and said, look, I'd like to stay, and so they actually let me stay there. And there's just something so dynamic about the FX market specifically and bond market secondary, in that you can see whether you're right on a daily basis. So you can have medium-term views, but this whole point of like you're pitting yourself intellectually up against people, you're trying to do good for your investors, but also you have, it's very outcomes based. And so there's something, it's quite, for want of a better word, intoxicating to work in the markets. And the other thing is you work with some of the most cleverest, brainiest, intellectual people you've ever met, talking about massive world issues that affect people. I couldn't imagine a better job. Yeah,
interesting. Do you remember an early trade or an early investment that sort of shaped how you think, something that stands out as one of your early impressionable experiences?
Yeah, I mean, it's funny because I started as a trainee fund manager back in February '94, and I started on the 7th of Feb, and I remember it distinctly because the Fed hiked rates on the 4th of Feb in the market, and obviously took it very badly, and so the 7th, everything was crashing down my first day of the office. And so, when I started was a very volatile period, and then probably 6 months later I was actually doing my own trades, which these day and age you spend a long time coming through as a trainee fund manager and things, but back then the progression was a lot quicker. So obviously I was being overseen, but I started on gilt portfolios, and I always remember that the back end of the gilt curve, it's driven by the pension funds for asset liability reasons, and it's kind of like the wild, wild west. And they call the 30-year gilt the widow maker. And I feel like the back end of the US curve is pretty much the same thing now. Unless you're right in the mix and you know exactly what's going on, you will lose money constantly. And so it's one thing, it taught me that you've got to really focus on just a few things and do them well. And the broader you set your remit, the harder it becomes.
So what are the few things that you now focus on? Like when you say you try and focus on a few things that you want to do well, where have you set your sights?
Well, for me, it's about, I've got quite a big team under me now. When we bought the boutiques together in Pendal back in 2010, I was appointed to run it. I think there was 5 of us, and we're 15 or 16, and we're currently in the process of hiring. So we've got quite a big team. But for me, it's about bringing together the ideas and the thoughts of the incredibly experienced and bright team I have to form our themes. And we've got so much experience, but how do you pull all those ideas out of people and to try and give you an idea of where effectively the world and markets are going? When you try and determine where world economies are going, that's hard enough, but then you try and bring in supply and demand for different asset classes, it becomes even harder. So I think the key thing is to have this strong fundamental view that makes sure you have this strong regard for the market, and the markets tell you if you're wrong very blatantly, and so you just need to listen to them.
Interesting. One of the we speak to a lot of equity investors, and they all preach from a similar hymn book about the macro often creates noise around stocks, and they focus on the fundamentals And a lot of it stems from this view that the macroeconomic environment is incredibly difficult to predict. How does what you do and the difficulties of making predictions around economies and currencies, what's the difference between that perception that it's incredibly difficult, almost impossible to forecast, and the fact that you are professionally managing a portfolio of instruments that operate in this world? How do you marry up those two narratives?
I would say that there's one fundamental driver of all asset classes, and that's liquidity. And that is determined by the credit cycle. So as you go through periods of increasing liquidity, we tend to find assets, risk assets perform well, and in periods of declining liquidity, risk assets perform badly. And then there's some correlation between bonds and equities that happens. But everything is fundamentally driven. Now, obviously, it's individual stock idiosyncratic stories like an Amazon or a Google, that the micro will outweigh the macro. But the macro is still relevant, and especially as you get into more mature businesses and then you come into government markets and FX markets, the macro is largely the only thing that matters. So trying to get a handle on the liquidity environment, where we are in the credit cycle, is absolutely key.
Mm-hmm. And so the obvious question is, seeing as you've brought it up, what's your view on where we are in the credit cycle? In Australia, availability of credit's a big issue.
Yeah, that's correct, and that's at the micro level about what's happening post the Royal Commission and the lending standards. But when you look at the credit cycle, it's about what's the velocity of money, what's money supply doing across the world, where's their credit creation, where is their credit, where's credit being squeezed, and it's quite clear when you look across the world now that there's a tightening credit environment. And that tightening credit environment brings two things. It brings lower asset prices generally, and it always brings high volatility. So these are two things we need to really bear in mind, given we have this backdrop of tightening credit across the world.
Okay. Well, I did promise that we were going to start on a positive note, so let me bring in this question. We tend to accustom ourselves to bearish commentary when it comes to bond markets, but if we flip it around, what are some of the things that you see making headlines right now that you think investors don't need to be concerned about, or that we can, if there are even elements of what you see in the economy right now, that we can actually be positive about?
Yeah, I think there's a few things. Firstly, the US-China relationship. I think that the market has got itself into a position where it's worried about the short-term impacts, but I don't know if this is positive or negative. Our belief is that that this moving apart of US and China, so effectively the re-onshoring of supply lines, etc., and the defragmentation of the fragmentation of the world into effectively a US-centric bloc and a China-centric bloc, is something that's going to happen over the next years and decades. So I don't think it's something that we need to focus on right now and have a view on right now, because you will see the US and China bumping up against each other for much longer than the rest of my investing career. So I think that's something that's probably blown out a little bit out of proportion right now. Mm-hmm. The other thing is North Korea. It seems to me quite clear that the North Korea problem is solved, but the problem is it's effectively that North Korea is allowed to maintain its nukes, but as long as they can't hit the US, which perversely means, I don't know if it's good or bad, but Asia needs to now do a nuclear arms race to try and have a deterrent against North Korea. And so that's good for some sectors, it's bad for others, but it brings more volatility as well. But generally, when you look at things, there's always this adage that things happen slower than you expect them to, and then things happen later than you expect them to, then faster than you expect them to. And I think that kind of sums up where we are in the world. That things take a long time to happen, but then they happen very, very quickly.
Mm-hmm. And what about on the domestic front here in Australia? There's political uncertainty. Mm-hmm. We're seeing this housing slowdown. Yeah. The business conditions that just got recently printed showed that dramatic slowdown at the end of 2018. Yeah. What's your temperature check on how things are travelling down here?
Domestically, it's kind of the malaise that's global. I mean, what do we see? We see tight labour markets. We see strong employment growth. We see no real wage pressures and no inflation. And so the central bank has reasons to hike rates. The central bank has reasons to cut rates. Right now, the RBA has more reasons to cut than hike, but it's quite clear they don't want to do either. But when you look across, the problems we have down here are not idiosyncratic to Australia. They're global problems, and largely it's because of what's happening in China. And it's quite clear that the market's been has a misconception about, or been caught wrongly on their view on China in terms of how the stimulus is feeding its way through the economy and the nature of the stimulus. And I think now that there's this reassessment about the fact that the stimulus won't be as expansionary for Chinese GDP growth as it was largely expected, and secondly, that will have less implications for the rest of the world. And when you look at the world, there's largely only two drivers. There's China and everything that drives off China, which is Europe and Asia and Australia, or there's the US. But there's only really two independent drivers of growth now, and those two are quite linked anyway. So looking across the world trying to find pockets of growth when you've got China and the US both slowing, you know, it's very difficult to find anything that's positive, and Australia's kind of caught up in the middle of that.
So when we were chatting, I alluded to it earlier. You said to me that you were more bearish than you've been for some time. Can you talk me through why you hold that view and put forward a bit of evidence that backs up that position?
Yeah, and it's really a view that's come around for the last few months, and it's to do with, we talked about the China picture. So the stimulus is very targeted, it's less broad-based, and therefore the impact on GDP growth and global growth is going to be less, and also the slowdown in the US is gathering pace. And you look across the world, and the places that derivatives of China, effectively Asia and Europe, are doing very badly as well. So this is a synchronized global growth slowdown. And you can look at the US economy and make a strong argument that the Fed has actually over-tightened rates. Because if you take the amount of times they've tightened, plus the balance sheet runoff, it's arguably more than you do in a normal cycle, and the forward-looking indicators are very weak. If you look at, you know, the manufacturing surveys like ISM, the New York Empire, you know, fully fed, all of these things are turning down. You look at the consumer, it looks completely tapped out. Like last night we had the consumer confidence numbers, and the ratio of expectations to current conditions is at a level only normally seen before recessions. So it looks like we're into a point where not only is the US slowing, and I'm not saying we have to enter recession now, but global growth is slowing, and we're in a situation where liquidity is still tightening. And so people look at it and say, well, if you have that environment, do you think that the Fed will be cutting rates? Well, the other argument is also in the US you've got burgeoning wage problems. So I think it's quite easy to see a situation where wages are picking up, but because oil prices have fallen so much, headline inflation falls from maybe 2 to 1, core inflation does nothing, so you get this margin squeeze that starts pressuring equities. So when I'm looking at 10-year Treasury bonds at 2.83%, they look pretty good value to me. And that, really, you've not been able to trade bonds from the long side. Arguably, Q4 was an exception for a year and a half, couple of years, and everyone was convinced there was a bond bear market. But now you're looking at a global economic slowdown with very few measures that central banks can do to arrest the slowdown. Fiscal policy largely tapped out across the world, so it means that bond yields should be lower than this. So we're slowly building into long duration positions, and the great thing about being long duration is it's positive carry and it gives you tail protection. So it's a very, very good environment for defensive bond fund managers.
I mean, that's a completely different narrative to what was dominating markets 9 months ago, where the 10-year bond had gone through 3% and people were talking about 4% and even higher.
Yeah.
So has there been so you think that there's been a significant turnaround in what the economic outlook is from 9 months ago?
I think there's two things that happen. One, the economic environment has turned down markedly, and you can see that in the numbers, and it really pretty much started around the August-September time. If you look at the chart of, say, Korean lead indicators, they've fallen off a cliff since then. So that was pretty much the peak of the cycle, and globally everything has slowed since then. But I think there's also a realization that prior to bond yields selling off, everyone believed there was a bond bear market that equities would be able to weather quite well. And now there's a full realization of how much debt there is in the world. And as bond yields go up, well, then that's really problematic, and then equities ultimately come under pressure. So we had this, the first time bonds hit 3%, equities came off, then bonds hit 3.25%, equities come off. And now I think that the market knows that you can't have bond yields going up without the rug pulled out from risk assets. So there's a realization now across the world that bonds are actually, low bond yields are a good thing. And I was in Hong Kong last week, at a couple of macro conferences, and there's this realization that bond yields can't trade too high. Now, obviously, you can get Italian and French yields and all the peripheral ones trading high, but you can't get, bunds, gilts, treasuries, JGBs trading high. The world can't handle higher interest rates. And I've been saying that for the last 8 years, and the market movements we've seen over the last year just hammer that home. The world cannot handle higher interest rates.
Do you think the Fed has got that message as well, given the pause in what had been previously declared a straight line rate hiking process?
Yep, I think that the market reaction to the December FOMC meeting caught them at surprise, when they effectively said the balance sheet reduction was kind of set in stone, and then they got really scared. The equity market forced them into a complete 180-degree turn, and now they've written a put on the market. So I think where we see from here is the Fed's done with rate hikes. I can't see the Fed hiking rates again. I'm pretty much sure they're done, but they would like to continue balance sheet, because Powell was very vocal back in 12 and 13 about the QE programs and how they were effectively a short volatility trade. So he would clearly like the balance sheet reduced. So I think they do nothing on rate hikes, reduce the balance sheet, and if equities come down to say 2.3, 2.2 on the S&P, well then that's where the put level is written, and so at that point you expect them to stop balance sheet. Mm-hmm. So I think that the markets are, are chopping around now, but the bias is towards higher volatility and lower asset returns.
Yeah, I guess if I'm to look at a positive through that, mm-hmm. it seems like the Fed does have a few different levers that they can, if they want to take liquidity out of the system, they have a few different levers to pull now.
The Fed's in a great position because it can stop quantitative tightening, it could cut rates, it could start quantitative easing again. The Fed's in an absolutely brilliant position because it has tools at its disposal, because it's actually moved rates and tightened liquidity. When you look at BOJ, so you look at Japan and Europe, they have nothing. They're still, Bank of Japan is still easing policy, but only marginally, and they really don't want to start easing policy again because they know it's killing their banking system. And Japan and Europe, they only stopped easing monetary policy because of operational reasons. Either they ran out of bonds to buy, and the political hurdles to start them again are terrible. And so you've got no monetary policy and stimulus in Europe. You've got no fiscal policy stimulus, and the economy's on its knees, and there's nothing they can do. So the US is actually in a good position.
In terms of the rubber hitting the road when it comes to investment, I guess my first question is, a lot of Australian investors will have investments offshore, mm-hmm. and for them the cross rate between the Aussie and the US has a big impact if they want to use hedging or not use hedging. Can you give me a sense on your view on how the US and the Aussie trade against each other over the next 12 months?
I think that comes really down to the US story. And our belief, so the market is a very strong consensus that the end of US exceptionalism and the loss of the reserve currency status in the US will mean that the US dollar weakens over the medium term. We're not so sure, because the US, even though it's slowing, will still have higher growth than the rest of the world. And also, because it's tightening, it's still doing quantitative tightening, it is tightening monetary policy, and that pulls dollars into the US. So we believe on a medium-term view, the US dollar will go up. When we look at Australia, we struggle to see anything too idiosyncratic around Australia. So when we think about the currency, it's more about what does it do relative to the US dollar, i.e. the dollar's moving and therefore the derivative is the Australian dollar. So on a trade-weighted basis, we don't expect Australia to move too much in the medium term. But you could see the dollar strengthening, so 65 would be a reasonable idea. But on a longer term basis, we are bullish on Australia. Australia's made a very good transition away from base material exports towards tourism and education. It's gone a long way to working itself out of the overvaluation of labour, and it's coming through quite well. And so you've got to be bullish about Australia in the long term. Just obviously the short term, it has its problems.
Interesting. When you look across asset classes in 2019, where do you think investors are most likely to generate a positive return? And on the flip side, where do you see asset classes or an asset class that you think is most likely to deliver a negative absolute return?
Okay, that's the asset which will give you the best risk-adjusted return in the entire world is US dollar cash, because it's an investable asset class. So I think US dollar cash is a great asset class right now. An extension Aussie dollar cash, they give you optionality on buying assets at a cheaper price. So I think.
So in your world, is that the 10-year bond?
No, actual front end cash. Cash is a good asset class right now.
Right.
Because we believe that given the level of asset prices across the world, that you're going to see low returns going forward. So having a higher level of cash in your portfolio is a prudent thing to have. Obviously, an extension of that is bonds, because bonds will give you capital gains as well. Mm-hmm. But then you take market risk to get that. In terms of the asset class we believe will do poorly, and that's credit. Now, we're not worried about Australian, domestic credit, because there's no problems here and all that credit's money good. We worry about predominantly the US high yield and European high yield markets, and the markets which have been only survive on very easy credit environments. And now we've had front-end interest rate hikes by the US and tightening liquidity across the world. We're beginning to get creaks in a lot of those markets. And as soon as you start getting companies that are downgraded, they move down the rating bands very quickly. And in a stressed liquidity environment, that's really not a good place to be. So we are actively short in credit securities across a number of funds that can do that trade.
For people that are watching this interview, I suspect not many of them would have exposure to high yielding credit in US or Europe. If those asset classes come under pressure, where does the next flow on effect?
Well, it has to come into Australian credit. So even though you can have a fundamentally strong view on Australian credit, if other credit asset classes across the world are coming under stress and hit liquidity problems, that will manifest itself in Australian credit. And Australian credit will underperform as well in that environment. So while we believe Australian credit is fundamentally good, we worry about stress liquidity conditions impacting the returns.
One of the narratives that came out of the period of quantitative easing was that bonds and equities became more correlated than they had historically been, and that reduced the defensive capabilities or characteristics of bonds in a portfolio. How did you see bonds perform over 2018, and what's your view on their ability to provide defence in 2019?
Yeah, and it's quite clear that some quantitative easing drove up the value of all asset classes. I mean, that was what it's supposed to do. You buy government bonds, you force people into corporate bonds, then you drive up the price of corporate bonds, you yield forwards, you drive them into equities, and you drive them to emerging market equities. Effectively, you drive up the price in all asset classes until the returns, the yields, equalise largely at zero, and that's pretty much where we were. So it was no surprise that bonds and equities sold off together. I mean, that was expected, and that was one of the reasons why we launched the Vol Fund and been building a Vol Fund that we launched in December, on this expectation that bonds couldn't always provide that negative correlation to equities when you need it. You could have a bond bear market coupled with an equity bear market. But where we are now, and that was true for most of 17 and 18, but now we're in a point where the economies are turning down, the buyers of bonds are coming back, and so the defensive characteristics of bonds are definitely coming back to the fore. But sometimes it's good to have more explicit protection in your portfolio, and that's why I think having a combination of bonds, which are an implicit protection, along with something like a volatility fund, which is an explicit protection against equity market weakness, work very well together.
Okay. Well, Vimal, great to catch up. Thanks for coming in, and all the best for 2019.
Thanks, James. Thank you for having me.